One of the most important aspects of entering into a position in any market is to determine the market structure. As you can see here in this example, the market looks messy and we are unable to determine what is the price action structure. But if we go ahead and draw market structure on the chart, it becomes very clear in what direction price is trending, and we can see exactly where our retracements, breakouts, and reversal points are. However, many traders struggle with determining how to draw market structure and how to determine appropriate swing points in live market conditions. Without being able to do this, even if you use a trend detection indicator on the chart, you will still experience significant losses, as a lot of times trend indicators are unable to detect ranging markets. A solution to this issue is the 1-2-3 trend continuation pattern indicator. This indicator will automatically draw the market structure and plot the exact take profit and stop loss levels on your chart. As you can see, once we added this indicator to the chart, the price action structure becomes very clear and allowed us to see exactly how price is trending. Along with this, the indicator will even allow you to select what risk to reward you would like to use on trades. Let's first add the indicator to our chart. To do this, let's go to the Indicators Search tab and search 1-2-3 Trend Continuation Pattern. Select the indicator made by this user and add it to the chart. Now let's view the indicator's input settings by clicking on the gear icon. As you can see, we have 3 options available. The take profit multiplicator value controls how far away the take profit is from the stop loss. By default, this is set to 0.5. So you'll notice that wherever there is an entry label, if you draw risk to reward from the stop loss to take profit, you'll notice that there is a 0.5 risk to reward ratio, which is a negative risk to reward ratio. By having a lower risk to reward, this can allow for higher win rates, but it will be harder to find long-term success. So we can adjust this value to 1.5, and we can now see that the indicator plots trades with risk to rewards based on a 1.5 risk to reward ratio. Next, we have the high-low length. This option controls how the indicator detects market structure. 5 means that in order for a swing point to be detected, the indicator will need 5 candles to the left and right of the highest and lowest candle for it to be considered a swing point. So if we look at the chart, we can see the swing points at market structure, and at each of these points there is at least 5 candles to the left and 5 candles to the right. And the final option we have here is the Show Orders option, which you can use to determine if you would only like to see bullish trades or bearish trades. We will leave that on default. The only option we will change here is the Take Profit Multiplicator factor, and we will change this to 1.5 so we can have a 1.5 risk to reward on trades. Now let's take a look at how the indicator works. The main feature of the indicator are these zigzag lines that is being used to determine market structure. As the market makes higher highs, this is considered an uptrend, and as the market makes lower lows, this is considered a downtrend. In an uptrend, when the market breaks a previous higher high, this is considered a buy signal and an entry label is plotted. At the market higher low, the stop loss label and take profit is also plotted. You can execute a buy trade based on these labels. Sell positions are plotted when the market breaks an uptrend structure and starts to make lower lows. When the price breaks a lower low, a sell entry label is plotted with stops above the lower high and a take profit that is 1.5 times the stop loss. The indicator can also be used to determine when a market is ranging. If we go into the settings of the indicator, go to the Style tab and disable the labels. Now we can see market structure more clearly. If you look closely, we can see that if a market is in an uptrend, it should continue to make higher highs and higher lows. However, if the market fails to make a higher high or lower low, this is usually an early indication that the market might begin to consolidate. As long as the market remains within this region, this would be considered a consolidating market, and we would not execute any trades until price breaks out of this region. Here is another example. Here we can see that the market is no longer making lower lows and has started to consolidate. We can draw a line between these two levels. We will wait for a breakout before seeking an entry. Now here we can see we have price breaking out of the consolidation. We can now wait for an entry signal outside this region and execute our trade. Another method of using this indicator is to identify certain chart patterns such as double tops, double bottoms, and the head and shoulder pattern. By using the lines drawn between swing points, it allows us to clearly see the swing structure in the market, eliminating a lot of the noise seen when looking at raw candlesticks. Here we can see the market has made a double top and is now breaking below this low. This is a great example of a sell trade. You could set stops above the swing high and target a 1-to-2 risk-to-reward ratio. Here is another example, this time a double bottom. By using the lines drawn between the swing points, we avoid trying to over-optimize patterns by being too exact, and we're able to quickly detect these patterns. Double bottom is a bullish pattern, so we can set stops below swing lows and target a 1-to-2 risk-to-reward ratio. If using this indicator to trade chart patterns, always remember that chart patterns should always be used as confluence in your analysis. For example, here we can see we have a pattern similar to a head and shoulder pattern on the 4-hour time frame. So we are expecting price to go bearish. We can go to a 15-minute time frame to trade inside that pattern and wait for a sell signal to be plotted before executing. Now we will share with you a way to utilize this indicator alongside a trend detection tool in order to get even more accurate entries. But before we continue, don't forget to like and subscribe to not miss out on future videos, and if you would like to try the #1 premium indicator on TradingView by Lux Algo risk-free for 30 days, you can use the link in the video description. Your continued support greatly helps the channel. Go ahead and click the indicator search tab and search Smooth Heikin-Ashi. This one by Jack. Once added to the chart, go into the settings, and let's change both length to 100. Let's go back to the 1-2-3 trend continuation pattern indicator, and let's ensure the take profit is set to 1.5. Now here is the strategy. We will be using the Smooth Heikin-Ashi indicator to determine the long-term trend in the market. If the candles are printing above the green Heikin-Ashi indicator, the trend is considered bullish and we want to seek bullish market structure trades. And if the price is trending below red Heikin-Ashi candles, this indicates long-term bearish bias, and we want to seek bearish market structure trades. Before entering a position, we also want to ensure that the market is not consolidating between two swing points. Here is an example of a buy trade. Let's go to the 1-hour time frame. Here we can see that the long-term trend is bullish, denoted by the candles maintaining above the green Heikin-Ashi indicator. Here we can see we have a bullish trade setup based on market structure, but if you take a look closer, we can also see that the buy signal is actually between two recent swing points, which means there is a strong chance the market is ranging. So we will not execute on this trade, and we would need to wait for price to get to an area where there is a more clear market structure. In this example, we can see that the long-term trend is bullish and there is a signal based on the bullish market structure, and if we plot the price trend we can see it is clear. We can execute with stops at the stop-loss label and target the take profit above. For sell positions it is the opposite. Here we can see we are in a long-term downtrend and the market structure is bearish, and based on the swing points there is no consolidation. Given that this is a clear signal, we can execute the trade based on the stop-loss and profit target levels. When entering positions, it is also important to ensure you use this alongside your technical analysis to ensure the take profit level is reasonable. For example, here we can see that we have a take profit level of 1.5, but if we look closely at market structure we can see that there is a strong level here of rejection. Once price gets to this level, you may want to tighten stops to prevent the market from running against you, protecting you from losing profits in the event this happens. A good way to determine these strong levels is to locate areas of potential order blocks. The Lux Algo Price Action Concepts indicator can automatically plot these order blocks for you, and you can create alerts for when price is approaching these levels to be more cautious when trading and to have a more dynamic take profit system. We hope you enjoyed this video on the 1-2-3 trend continuation pattern indicator that can be used to easily determine market structure and plot take profits and stop loss levels and remove a lot of the guessing from your analysis. Don't forget you can use the link in the video description to try Lux Algo Premium risk-free for 30 days, where you will get access to the oscillator matrix, price action concepts, and the signals and overlays indicator. Keep learning, stay safe, don't forget to like and subscribe, and we will see you again very soon.